I can't explain my attire tonight. This is just how it worked out. It is Thursday, and it's the night before an important jobs number. We had a meeting today here at Bell Point. I wanted to share with you at home some of the charts that we looked at today in advance of the meeting. And there's a lot of push and pull regarding this meeting. We know about the war between Donald Trump and Jay Powell, the firing of Lisa Cook, a lot of drama. And recently, the indications from Jay Powell are that he is going to be cutting rates. However, we've seen in the past that could evaporate overnight if we get a hot jobs report in the morning. But I would say from these charts that I'm about to show you that some of the data regarding jobs has been soft. Take a look at non-farm payrolls for the last couple of months. That break-even line, we're not even keeping up with what we need to keep employment on an even keel. We've been living below the break-even line, and we're not expecting a lot tomorrow. I think consensus for the non-farm payroll is somewhere around 75,000. Could easily beat that, but that whole conversation about BLS data being somewhat suspect, the big revisions that we get, I've been a real critic of BLS data in the past. But nevertheless, when you start to look at this stuff month after month after month, the data looks a little bit soft. And that's in large part why the Fed has been leaning towards making a cut recently. Look at this next chart. Even when you look at the number of jobs that have been cut, it's not as draconian as that blue sharp spike high in 2025 would indicate. That includes government payrolls. And we know when Doge stepped in with Elon Musk, there was going to be a lot of firings in the federal government, and that's happened. But even the black line, which kind of takes the government numbers out of the equation, even that is elevated compared to the last few years. And that leaves us with what the consensus is looking for from the Fed sometime later this month when the Fed meets, and the expected cut is probably going to be 25 to 50 basis points. Some are leaning towards 50, but right now it's a 95% probability. And if that number holds to just up before the Fed meeting, that's a lock. However, as we have seen in the past, a hot jobs number tomorrow morning could probably cause a lot of consternation and make it almost impossible to guess what the Fed is going to do. But we're going to try anyway. Welcome to The Money Runner. I'm David Nelson. We spend a lot of time on this show talking about stocks, individual securities, sectors, themes, but you cannot ignore fixed income and what's taking place in the bond market. And on Tuesday, we came back from a long holiday weekend, and it was kind of a wake-up call. I looked at the futures on Monday, pretty benign, nothing really going on. Woke up Tuesday morning, stock futures were down hard, but what really struck me is yields across the world, not just here in the United States, across the world were markedly higher. And it wasn't just, one tenor. It was all across the yield curve. And of particular note, what really struck me is when I looked at this chart here, take a look at this, the 30-year UK gilt, their 30-year treasury. And you look at that, that reached the highest levels since 1998. Now, that doesn't happen without good reason. So it immediately made me, switch over what's happening in our bond market. And I looked at our bond market, and I put this chart up here, and we're going back, I guess, to the 90s. And those little circles there, are all peaks somewhere around 5%, above 5%. And I, like many others, have said, we start living above 5% in 30-year treasuries or 10-year treasuries, and it's an entirely different conversation because, remember, most valuation models start with the risk-free rate. So if the alternative in yield, being treasuries, is more attractive than the earnings yield or the free cash flow yield of stocks, it's a challenge. It's a challenge for equity. But as you can see in this chart, every time we get above 5% or close to it, the buyers seem to step in. And that's exactly what happened this week once again. So the alarms went off, and then people went and stepped in and bought the long end of the curve. And that's been the narrative all week. Why in fact did that happen? I started to think about it, and I put together this little graphic here that kind of shows you my thinking. Late last week, I believe after the close on Friday, we got word that a federal court judge had ruled that at least a portion of the Trump administration tariffs that are out there were not legal, that they should not have been done. However, they put a stay on it, giving the administration time to approach the Supreme Court, which is in fact exactly what they did. And they've really reached out to the Supreme Court to make a decision quickly. Quickly is may not be as quick as you'd like it to be, but apparently, from when I talk to constitutional lawyers, even lawyers who've argued before the Supreme Court, they feel that even on a fast track basis, the soonest we would see anything on this is probably November, and maybe not even a decision before the end of the year. That creates a lot of indecision, and I think if I was a bond investor, here would be some of my concerns. You can see them on the left side of this chart here. Well, first, the United States would lose some revenue. The tariffs are bringing in a significant amount of revenue, and a lot of that revenue was meant to offset the tax cuts. The deficit would widen further. That would bother me if I was a bond investor. And that, of course, would create uncertainty as the administration, tries to get some judicial relief. However, we may find that it ends up being a wash. What if, in fact, it did hold that way? Well, the other side of that sheet goes to the positives. You'd have lower import prices, all right? You see a boost to trade volumes. That makes sense. And finally, margins would probably climb for a lot of companies. So the tariffs were kind of factored in here, so maybe we'd have to unwind that, and maybe that would take the pressure off bonds. Maybe it takes the pressure off the Fed, making it a little easier for them, because that was one of the big concerns. But never, net, it may end up being a wash. And why is that so important? Because we need the Fed to cut, all right? Stock can probably do okay without that, but if the Fed is cutting and you mix that with the tonic of, say, earnings estimates pushing higher, that's a pretty powerful incentive for stocks to go higher. So I want to see that happen. So I put together this chart, and it goes back, I think this goes back 40 years. What you're seeing on top there is the Fed funds rate, all right? And those little red bands there that my guy Chris is zooming in on and out on, that's recession periods, all right? Those yellow lines or bands that I put in there highlight a particular area, because on the bottom there, that white line is the S&P 500, and that green line is earnings. And what I've highlighted there is periods of time when the Fed is cutting rates, all right, but you're not in a recession or approaching a recession, and earnings are rising. That's a pretty good tonic for stocks, and stocks have generally done well. One of the best times is that period there in the middle where you could see rates were coming down. That's the entire build up to the dot-com, all right? Stocks did phenomenally well during that period. And here we are with the exact same situation. Earnings are climbing fairly strongly. You're seeing rates have already come down. They came down late last year, have stalled out since. But if the Fed starts cutting from here and you have earnings pushing higher, I want to be long stocks, and so should you. So I'd like to see that pan out that way. When I expand it even further and I start to put in some other valuation metrics in there, I like the picture even better. So you can see there, one of my concerns with this chart a couple of weeks ago when we looked at this was that earnings were rising, the green line on top, up and to the right, that's great, but they weren't rising fast enough. Stock prices were outpacing stock prices were outpacing the earnings. And what happens with that is the earnings yield which is just a PE ratio upside down. You take the earnings and divide it by the market cap, and you get a yield. That was declining. So we were getting earnings growth, just not enough of it. That may have changed, because if you look there, I know it's small. It's kind of like green shoots there. That earnings yield seems to have stabilized, and it's actually starting to move a little higher. I think that's good news. We're going to have to dive into that and see what's causing that. Why are stocks acting like, not that we're going into a recession, more like we're coming out of a recession? The AI trade. It's been a big part of this bull market for the last couple of years, and for good reason. It's certainly the most important investment theme in my career, and I'm always on the lookout for some company that is either found itself in the food chain and the build-out of artificial intelligence, or some company that has now adopted artificial intelligence and has found ways to enhance its top and bottom line. All right, we understand that. It's not just the large language models. Like I said, it's the data centers, the hyperscalers. NVIDIA is, of course, the pinnacle of the chip companies. All of that together has helped make up this ecosystem here that's certainly been very important for technology. But as this translates to other parts of the market and the economy, return on investment starts to become very important. We're spending a lot of money on it, tens of billions of dollars at every one of these companies. It's monstrous. It's massive. All right, we understand that, but it has to be done. But at some point in time, these companies want a return on investment, especially those in the industrial complex that are not making money off of the build out of AI. They're going to use AI, and in some fashion, it's going to enhance, like I said, their top and bottom line. So the timing of when they get that ROI is very important. Now, I stumbled on this chart before our Bell Point meeting yesterday morning, and I found it kind of interesting. What you're looking at there is operating margins, all right, profitability in the S&P 500, and this goes back to, I guess, calendar year 2021, that first bar on the left in there. And if I go all the way back to, say, 2007, I can see that operating margins on average somewhere between 13 and 14%. All right, that's a measure of profitability. They spiked up to 15% in 2021, probably as a snapback because 2020 was so bad. I think operating margins were somewhere in the high single digits, maybe 10%. And then they dropped again in 2022. We were in a bear market. They dropped again in 2023. And lo and behold, they started rising again. And they started rising dramatically. And in fact, for 2025, the year we're in right now, we may end the year at 17%. I can't go back 10 years and see a period where profitability was that high, at least at the operating level. And the projections for the following year are 18%, and the year after that, 19%. What's going on? Now, I've got no hard evidence that artificial intelligence is what's doing that. But I have strong suspicions that at least some part of that is AI. I know it's making me more efficient with what I do. Now you can utilize that efficiency two ways. You can find more leisure time for yourself, or you can find a way to do more. I've chosen to do more with this. So each basis point of improved profitability or productivity is massive for the market. All right, it's important. So if profitability goes up and earnings go up and rates go down, you put all that together, I want to be long stocks. All right, that's it for this week. I've got to look at the jobs number in the morning. I'll probably put out a post Sunday night or Monday morning. In the meantime, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.